They were celebrating. Markets were rising, banks were expanding, and investors believed risk had finally been tamed. But while Wall Street was applauding itself, Warren Buffett was doing something that made no sense at all. He was sitting still, holding cash, saying no, and quietly preparing for a future almost no one wanted to think about. Years later, when the world finally caught up, people asked the same question again and again. How did Buffett know this before everyone else? To understand that, you have to step away from the headlines and into the mindset of a man who never trusted excitement. Warren Buffett's greatest advantage was never speed, insider information, or complex models. It was something far simpler and far rarer: historical memory. Buffett didn't look at markets the way traders did. He looked at them the way a historian would. Patterns mattered more than predictions. Behavior mattered more than numbers. Long before he became a household name, Buffett spent countless hours studying financial disasters. The Great Depression wasn't just a chapter in a book to him. It was a warning written in human behavior. Banks that overextended, investors who borrowed too much, systems built on optimism instead of resilience. His mentor, Benjamin Graham, drilled one lesson into him early. Markets swing between fear and greed, and most people lose money by forgetting that those swings always come back. By the early 2000s, Buffett was seeing familiar signs again. Credit was easy, debt was cheap, financial institutions were growing faster than the real economy that was supposed to support them. New financial products were being sold as revolutionary, safe, almost foolproof, and most investors were happy to believe it. Complexity had become a shield. When no one fully understood the risk, no one felt responsible for it. Buffett felt uneasy. In 2002, he wrote something that would later sound prophetic. He warned that derivatives were financial weapons of mass destruction. At the time, many laughed it off. The world had moved on, they said. Finance was smarter now. Risk was diversified. Losses could be modeled away. But Buffett wasn't attacking innovation. He was questioning incentives. He understood that when profits are immediate and consequences are delayed, people take risks they would never accept if they had to face the outcome themselves. Inside Berkshire Hathaway, his actions spoke louder than his words. He avoided leverage. He rejected businesses he couldn't explain in plain language. He demanded strong balance sheets and predictable cash flows. And he did something almost unthinkable during a booming market. He stockpiled cash. Analysts criticized him relentlessly. Cash was dead money, they said. It dragged down returns. It meant missed opportunities. While others chased high-growth stocks and financial engineering, Buffett accepted underperformance. He was willing to look wrong in the short term to avoid being destroyed in the long term. Then the noise stopped. In 2008, the global financial system cracked open. Lehman Brothers collapsed, credit markets froze, institutions that were considered untouchable failed in days. What had been praised as sophisticated risk management was suddenly revealed as fragile and interconnected exposure. Panic spread faster than confidence ever had. Buffett didn't scramble. He didn't sell in fear. He didn't beg for liquidity. He already had it. While banks were desperate for capital, Buffett became the lender of last resort. He invested billions into companies like Goldman Sachs and General Electric on terms that guaranteed protection and upside. Preferred shares, high dividends, warrants. These weren't lucky deals made in a crisis. They were the result of years of preparation. Buffett later said that you don't discover who's swimming naked until the tide goes out. He had been watching the tide for a long time. After the crisis, the world tried to ensure it would never happen again. Central banks slashed interest rates to near zero. Trillions of dollars were injected into the economy. Asset prices surged. Stocks, bonds, and real estate climbed together. Once again, optimism returned. And once again, many believed the rules had changed. Buffett stayed cautious. He warned that prolonged low interest rates could distort decision-making. When money is cheap, mistakes are easy to hide. Bad investments survive longer than they should. Valuations drift higher, not because businesses are better, but because alternatives look worse. Buffett reminded investors that value is always tied to future cash flows, not excitement. As speculation returned, so did criticism. When Buffett held back from trendy investments, people said he was out of touch. When Berkshire's cash reserves grew even larger, commentators claimed he had lost his edge. The world was moving faster, they said. Buffett was moving too slowly. Then came the shock of inflation. Supply chains fractured, prices surged, central banks were forced to reverse course, interest rates rose at speeds markets weren't prepared for. Suddenly, companies that depended on cheap debt and endless growth began to strain. The same leverage that amplified gains now magnified losses. Buffett, once again, was positioned for reality. His largest investments were in businesses with pricing power, companies that sold products people continued to buy even when prices rose, firms with strong brands, real demand, and durable economics. These businesses generated cash in good times and bad. They didn't rely on financial tricks to survive. What Buffett knew before everyone else wasn't the timing of crises, it was the structure of them. He understood that systems don't fail randomly. They fail when incentives reward short-term success at the expense of long-term stability, when leverage replaces patience, when complexity replaces accountability. These conditions repeat across decades, regardless of technology or policy. Buffett often said that investing is simple, but not easy. The hard part isn't understanding numbers, it's controlling behavior, resisting the urge to act when everyone else is acting, accepting boredom in a world addicted to excitement, preparing for outcomes that feel distant and unlikely. Inside Berkshire Hathaway, this philosophy shaped everything. Managers were encouraged to think in decades, not quarters. Debt was treated as a tool, not a strategy. Growth was welcomed, but only when it strengthened the business instead of stretching it. Mistakes were tolerated. Recklessness was not. This approach didn't just protect Berkshire, it influenced how investors and executives thought about risk. Balance sheets regained importance. Cash flow mattered again. And slowly, the idea that resilience should matter as much as growth returned to the conversation. Today, markets face new frontiers. Artificial intelligence, private credit, geopolitical tension, and technological disruption dominate headlines. Once again, voices claim that old rules no longer apply, that innovation has rewritten the fundamentals, that risk can be engineered away. Buffett has heard this before. He doesn't dismiss change. He simply refuses to confuse novelty with safety. He knows that while technology evolves, human behavior remains remarkably consistent. Fear, greed, overconfidence, and denial still drive decisions, and they still create cycles of excess and correction. The reason Buffett knew before everyone else is uncomfortable for many to admit. He wasn't smarter than everyone. He was more disciplined. He was willing to wait, willing to be criticized, willing to miss out, and willing to prepare for outcomes others preferred to ignore. In the end, Buffett's greatest insight wasn't about markets at all. It was about people, about how systems behave when incentives are misaligned, about how stability is built quietly long before it's needed, and about how the biggest advantages often look like mistakes until they aren't. In a world that rewards speed, Buffett chose patience. In a world that chased certainty, he accepted uncertainty. And while others searched for the next big thing, he prepared for the next inevitable one. That is what Warren Buffett knew before everyone else.